Hey guys, welcome to another Trade Genius podcast. Bob and Phil here. Guys, hold on to your jobs. It's not going to be pretty. We're going to talk about it. Let's go.
Trade Genius.
Hey everybody, it's Bob with Trade Genius. Usually I do fun ads. I talk about our service, but I want to be serious with you for a second. We've been helping a lot of people trading for a long time. As you can see here, I want to let them do the talking for me for a change. But most importantly, we want to help you too. If you've not joined our service yet, come check us out, tradelikeagenius.com. Full service. You know, we have a chat room. We have the algorithms for you. We give trades out every day. We educate you. So go to tradelikeagenius.com. Check us out. What you get out of our service is much, much more than what you put into it. And we'd like to see you in the room. Thanks for listening.
So Bob, this chart here, I mean, we know unemployment's ticking up. We've been talking about that. It's going to be a key part of what goes on in the Fed's decision-making process and really as we grind toward a recession, I think. But this chart, I mean, whoa, like jobs are really falling off a cliff.
Yeah, I mean, you know, the unemployment number is a massive lag, but there's a chart here we're going to show you in 1 second that's a predictor where it's ahead of the data, and that's the job openings. And check this data out here. Job openings. No bueno is right. Is absolutely collapsing. And in California, it's even worse because they basically raised the cost of labor, and it's forcing a reassessment. I was telling people in the room today that Rubio's is closing 48 more restaurants in the state. They've gone from 180 to I think 50 stores right now after this next round of store closures. They're only keeping the most profitable stores, and they're getting hit in two ways. One is the labor rate is killing them now, and the rental rates are killing them. And they're sitting there saying, okay, if I don't have a certain ROI for a store, I'm closing it. And the other thing that's happening, it's not really reflected in this, is that there's shrinking hours, Phil. So we have to start looking at average hours worked now too, because, you know, there are places here that, you know, the bagel shop that I go to every day, these guys are up 7 days a week. It's family owned. But what they're doing now is that there's certain days of the year where they don't make an acceptable ROI. Just being open to cover the rent is not that important to them anymore. And so now they're starting to take days off. And I asked him, so why are you starting to take these days off? He goes, we don't have enough business. You know, for us, it's I don't have to bring labor in. And psychologically for us, it's just less pressure on us. I think you're seeing that across the board. A garden center near us, same thing. Rates went from $16 to $20 an hour. They just closed. Our leases up were closing. And then the consolidation. And I just was listening this morning, Smart and Final, you probably never heard of them, but their big grocery chain out here is that their warehouse, the guys are ready to strike because the rates have gone up on workers. They're going to automate the whole facility. They're closing it, getting rid of 300 jobs. And then they're saying, if you want to work at the next facility we have that's farther away, you can apply for those jobs. And I think we're just going to see that constantly fill. But the area that I think is really going to shock people is this next chart. And this chart has to be wrong, Phil. There can't be that much overemployment in a collapsing construction environment. And I'll throw it back to you because you're in this space for decades.
This is wild. And either the construction employment, and this is just for residential buildings, okay? So either this number is wrong, it's getting cooked, right? Which is the blue line, and it's actually lower, or we're going to have the mother of all layoffs coming here, which I think the latter is true. We're going to have the mother of all construction layoffs. So the job number, this is why this is all really starting to come together now, where we're going to see that unemployment number start to spike, and that's really going to push us into a rate cut, which I now think with pretty good confidence we're going to see in September. And that's just to give the unemployment rate enough time to scare the Fed. But looking at the divergence, again, I don't know how many alligator jaw charts we've shown you guys, but if you kind of ignore the red, which is housing completions, which also should start to come down and catch down to the green line. The green line is new housing starts, which we got that data. I think it was this week we got a new round of housing starts. Disappointed to the downside. We do see sometimes where housing starts will fall off and then catch back up. And, you know, housing starts basically, when you have tracts of houses, you can start a bunch of them, and then the guys can kind of start to go through in phases and build those things out, right? So you can start Housing start is, pull a permit, and probably I would think you would start, actually breaking ground. That would be the normal way to do it, but maybe they can cook the numbers and it's just pulling permits. But the fact of the matter is we're going to see a massive decline. Two things are going to happen. We're going to see the green line catch up with housing starts going right back up or not. And normally, if we're going to have that happen, we would already see this number kick back up. So we've had one of the largest declines in housing starts that we've seen since we got out of the great financial crisis. I just think that we're not going to see new housing starts. I think things are slowing down. I think we've peaked out already and the demand isn't really there. And on top of that, right, we got mortgage payments are not what they used to be because interest rates are higher. So what people can afford now is much different. And, as you saw with the Fannie Mae numbers there, the delinquencies from yesterday's video, right, going way up. So housing affordability stinks. We all know that. We know that the income to price of homes ratio is horrible, worst it's ever been by a long shot. So prices have to come down 30 to 40%. And right now we're in a standoff at the OK Corral between house prices and consumer demand. So I think the numbers are going to come down here on jobs, especially for construction and residential jobs. I think they're going to catch down in this case. Maybe we're going to see something dramatic like we saw in 2020 with COVID, right? Everybody's home. But I think we're facing a pretty dramatic slowdown. Now it's going to affect different parts of construction differently, right? So let's just say the median housing market for construction jobs probably going to suck wind for a very long time. First one to go. Then commercial and industrial stuff will happen. And then, your high-end luxury residential stuff will be more resilient because those guys obviously have more money. But trust me, those guys will stop spending too. It happened in '08. Everybody stopped. It didn't matter where you were in the wealth scale. From top to bottom, everyone stopped with their projects. Stuff that was planned all came to a stop. Why? Because if the money stops flowing for you at a level that you're used to, you don't need that extra luxury item. You just don't. And, wealthy people tend to be smart with their money. They don't tend to, run up debt just because they're used to a lifestyle. They will stop spending. Those guys love having their cash. They love knowing that their cash reserves are full. So I think you're going to see it all stop eventually. But median residential is typically your canary in the coal mine, Bob.
Yeah, it's going to be really interesting. And the thing about real estate is and housing, these are long cycles too. So, this could be a 3 or 4 or 5 year cycle before before it bottoms out.
Yep.
But we're going right into a teeth of a baby boomers that are leaving the earth too. So I think secularly, this is not going to be a play. There's not going to be employment. If you look at Southern California, we're pretty much built out, so I just don't see where the growth is going to come from. And so I think there's going to be many people leaving their home not voluntarily, and so there's going to be enough housing stock for people that want to keep moving in that you're just not going to need new housing. So it's going to be really interesting to see. But with that, guys, with chaos comes opportunity, and we're going to help you navigate through it. So come check us out, tradelikeagenius.com. Like I said, we have the last couple months of glory here before it gets gory, and you're going to be able to make money on both sides of this if you pay attention.
Yep.
And we can help you with that. So with that, enjoy the rest of your weekend. Thanks for listening to us. Tell your friends and enjoy the summer.
Trade Genius.